Rakesh has taught us one beautiful quote. It says, your patience may be tested, but your conviction will be rewarded. Most people focus on companies that can compound at a faster rate, but we are looking for companies which have the longevity, which means they have the resilience to go through economic cycles and continue to create wealth. Rather than thinking of the returns that you've already got, I would encourage you to think about the returns that are yet possible.
Lessons from 25 years, how to be vaguely right then precisely wrong in stock picking. When it comes to picking stocks, I go into analysis paralysis. So why not learn from the person who's actually leading Rakesh Jhunjhunwala's Rare Enterprises, the CEO, Mr. Utpal Sheth. So our speaker for this session is an investor veteran with more than 30 years of experience. He is the CEO and senior partner at Rare Enterprises and the founder and mentor of Trust Group. Mr. Utpal Sheth is the protege of Mr. Rakesh Jhunjhunwala and also the manager of his fund. May I please invite Mr. Utpal Sheth and Mr. Jagdeep Singh on stage.
Good morning, ladies and gentlemen. Good morning, sir. I'm pretty sure you'll learn a lot from you in next 30 to 40 minutes from your last 25 years of experience in the investment industry.
Thank you. I'll try to share as much of my learnings as I can.
Sure, sir. So let me start with very first question. You say gorillas are rare, dominant, and long-lived. So this is your framework to select the stocks. And you have invested in very good companies in the last 25 years. So we just want to understand how it actually works, how it helps you to invest in a very good companies.
Right. You know, the characteristics of gorillas are that gorillas are rare. So in a jungle, you will have maybe 5-10 gorillas. You will have maybe thousands of monkeys. So you are clear that you want to be invested in those gorillas and not in those monkeys. The second is that gorillas are dominant. You will not find monkeys around the gorillas. All the monkeys will be in a different area and the gorillas will be in a different area.
Correct.
We are looking for companies which have that longevity. See, investing is a game of compounding. So you will want to look for not just companies which can compound at a faster rate, but companies which can compound for longer. Most people focus on companies that can compound at a faster rate or grow at a faster rate. But we are looking for companies which have the longevity, which means they have the resilience to go through economic cycles and continue to create wealth. What are the factors which create these capabilities? So we found 3 important factors which make these companies gorilla companies. The first is what we call as mega trends. Second is leadership attributes. And the third is intangibles. Intangibles are things like the culture, the distribution model, the institutionalization of those companies, etc.
But if I talk about just like 1 or 2 parameters which you seek, if this is not working perfect, I will simply not invest in that company. It might have a very great growth potential. What is these 2 or 3 parameters?
See, if there is no mega trend,
okay,
for example, then I'm not keen on those companies. If there is no leadership attribute, then no point in tapping that. So megatrends create the addressable opportunity for that company and that business model to tap. However, if the right leadership attributes are not present, then though the opportunity is present, you may not be able to tap into that opportunity, right? To give you an example, in the 1990s, the whole IT services wave was there. And there were more than almost 100 IT services companies.
Correct. Those evolved during that time.
But how many of them created wealth? Maybe 10 of them, maybe 15 of them. Remaining 85 did not.
So let us say you have selected a stock, and whenever you select an asset, you always expect some return out of it for next 10 years or 5 years. And let us say you have expected a return of 3x in next 10 years, but that stock has given you a return of 3x within 1 year. So what should be the mindset at that particular stage?
You know, Eric Smith has said very nicely that we end up overestimating the short term and underestimating the long term. So rather than thinking of the returns that you've already got, I would encourage you to think about the returns that are yet possible.
Got it.
Okay? So if you are standing at the base camp of Mount Everest, you can't see the Mount Everest because of, say, low visibility.
Correct.
Because of clouds or whatever. Does not mean Mount Everest is not there. You don't need to know the exact height of Mount Everest at that point of time. You just need to know that it's a really very, very tall mountain out there. So always think of the potential which is yet to be captured, which we call as terminal value investing, rather than thinking of the returns that you have already got.
Got it. We have seen that a lot of people have a lot of conviction in a stock, and because of over conviction, I would say, and overconfidence, they keep on averaging the stock. And a lot of people say ki don't catch the falling knife, but they keep on catching it. And literally, I have seen in last 3-4 years, people have lost a lot of wealth in such kind of companies. So what is a thin line where conviction needs to be objectively thought about, and they should exit out of those companies?
So the whole point is, when you have conviction, you also need courage. There are people who have conviction but don't have the courage to buy. They miss out. At the same time, there are people who have the courage but don't have the conviction. They are foolhardy. Okay? Conviction is not just thumping your chest and saying that I have the conviction. Conviction means that your conviction has to be based on what we call as a differentiated insight. And then if the price goes against you, you can be patient. Doesn't mean that you have to keep averaging. However, if the price reaches a stage where your conviction multiplies, but you have to test your conviction. So again, Rakesh ji has taught us one beautiful quote. It says, your patience may be tested, but your conviction will be rewarded. Right? So I believe in that. What the scenario that you mentioned, where you keep buying at a lower and lower price, thinking that you have conviction, it means you are not revisiting your investment hypothesis.
Correct.
At every 20% down, you have to revisit your investment hypothesis. And if your conviction and your differentiated insight still tells you to continue holding, you should continue to hold.
In last 25 years, you must have made some mistakes while doing investment. How the learning from those mistakes has made you a better investor or a better informed investor?
Sure. See, we have had our share of mistakes, and we are not ashamed of making mistakes.
Correct.
There's no problem. However, we find that most people have this inherent tendency to avoid mistakes. We feel avoiding mistakes makes you avoid opportunities also. So you should not have an aversion for mistakes. Okay? What you need to learn is how to make mistakes that you can afford, so that you can live to make another one.
Got it.
Right? People only think that if I made a loss, then that is my mistake. Or if I made a big loss, then that is my mistake. We don't agree with that approach. We feel that there are 3 kinds of mistakes, and most people who are maybe economists or statisticians or accountants will understand 2 of them. One is what we call as error of omission, and one is what we call as error of commission. So error of omission is where you decided that this stock is worth investing in, but so you built the conviction, but you did not build the courage, and therefore you did not buy, and that stock goes up. That is the error of omission. The error of commission is where you bought the stock, you build a conviction, but your conviction was wrong, and the stock goes down. That is the error of commission. However, there is a third error. So all errors of omission, let's say in statistics they are called type 1 errors. All errors of commissions are known as type 2 errors. But I would suggest to you that there is a third error which is not mentioned in any of these textbooks, and that is what we call as type 1.5 error. That is the error of reluctance, which means you made the bet, it is 1-2% of your portfolio, and when your conviction goes higher, you don't end up increasing the bet.
That is the biggest mistake.
And that is the biggest mistake, because this is the known devil for you.
Got it.
It's not an unknown devil. You have a hypothesis, that hypothesis is validated, and yet you fail to increase the weight.
A lot of people follow the portfolios of superstars. Like those, all the information is publicly available. And people who are coming new to the industry, they simply follow those portfolios and keep on investing without looking out for their own personal risk. What is your suggestion for such kind of investments?
So see, there is no harm in following portfolios of super stocks, but not to follow it blindly is most important.
Correct.
So you follow, see what they are doing, try to understand why they are doing what they are doing. And you know what they have bought, but you don't know what is the weight in their portfolio of that stock, right? So if you end up making a disproportionate weight in your portfolio of that stock and something goes wrong, that person is not going to come and tell you to sell, right? So you can follow somebody on the buy decision, but on the sell decision, you will have to take your own judgment.
PE ratio, price to earning ratio, normally it's a very generic term and all talk about it. And in some sectors we have seen that PE ratio has been on a very higher levels. So do you have any range that you normally look out for that is comfortable for you to make an investment in that industry or in a company, even though there are a very high growth opportunities in future?
So investing is not mathematics based. There is no formula that this PE ratio is right or wrong, which is why we advocate this philosophy of terminal value investing, where instead of thinking about value today, you are thinking about value 10 years from now. Okay? And that value is a dynamic value. So it's not that today if the stock price is 100 rupees and terminal value in my mind is 1000 rupees, then that remains static. So which means 6 months from now, 2 years from now, in my mind the terminal value remains static. That's not true. That terminal value also keeps changing. So one has to keep assessing the current price versus that terminal value on a periodic basis.
So next question is very generic question. How do you see the outlook of the Indian markets for next 2-3 years? Like how do you suggest to the new investors?
See, I think India is an idea whose time has come. We have reached a critical mass. I would also say that India is on its way to earning the right to be an independent asset class within emerging countries. And third, I would say that a structural change that has happened is that the marginal buyer today is domestic capital and not foreign capital. Indian markets earlier were vulnerable to foreign flows. We are now far less vulnerable to foreign flows. The whole SIP wave amongst retail investors has also been very strong, and that is reducing volatility. Lastly, on the supply side, government used to be a continuous seller in terms of PSU disinvestment every year, which has not been happening for many years now. So there is a fundamental change in the demand supply for equities in the country, and the supply side response is taking a long time, which means we are not getting adequate supply of equities. That will happen over a period of time. But as of now, we are in this Goldilocks scenario where it is not too hot, it is not too cold.
So next question I want to take related to your legacy with Rakesh Jhunjhunwala sir. So he used to say you and Rakesh sir make 1 + 1 = 11. So what are the different personality attributes that you use to complement each other?
Very few people are great traders and great investors. I don't have those skill sets. Therefore, I can't replicate that. But I've had the privilege of learning a lot from him. I will just say that some of his words always stay with us. And I'll share some of those with you. One is your word is your bond. Second is that we value people for what they are or who they are rather than for what they have.
Okay.
Right? So you focus on relationships and not on net worth.
Okay.
Right? My favorite one always, which I'm now repeating, is your patience may be tested, but your conviction will be rewarded.
Got it, sir. So I think we all have learnt a lot from you in last 25-30 minutes, like some concepts like gorillas, monkeys, and terminal value of a stock, understanding the risk appetite. So thanks a lot, sir, for this insightful session. I just want to thank you from the behalf of the audience also. Thank you very much, sir.
Thank you very much.
Investment in securities market are subject to market risks. Read all the related documents carefully before investing. Please read the risk disclosure documents carefully before investing in equity shares, derivatives, mutual fund, and or other instruments traded on the stock exchanges.